The DIY chain Wickes is up substantially in the markets today. Bearing in mind there's a general downdraft in equities today, Wickes has performed really well. It's come through with first half earnings, which the company says has benefited from the rush that consumers have made into insulating materials to help them mitigate the cost of increased energy, and also LED lighting, which is far cheaper to use than ordinary traditional lighting. Let's take a look at the share price chart. The company, having reported these numbers, saw the shares initially up around about 10%. We're off the highs today, but we have successfully defended this line of support at 113.4. 124.8. I still be reluctant to go long on this, even at these levels at the moment. The company has had this rush into this area, which, as I said, is really related to these high energy costs. How long that lasts remains to be seen. Like-for-like sales were only up 0.8%, but over 23% up on a 3-year basis, in other words, before COVID. Revenue growth coming in to taking overall revenue to £822 million for the first half of the year. Interim dividend has gone up as well, from 2.1 pence to 3.6 pence. Now, this is a company that's been listed after having been sold off by the other major player in this market, which was Travis Perkins. They decided to get rid of Wickes and float the business. So you can see that it has been a difficult time for the company, having supported this and defended this line at 148, spectacularly dropping below that on the 26th of July this year. But now the company is up off this low at 113.4. But I'd want to see further evidence that the company continues to see good sales before I buy into this as a long-term buy on the stock from these levels. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.